Hi there. Let's take a look at another exam question. This one's a 9-mark question that considers the management decisions that are made in the context of being a public limited company. There's the question. It was based on a short case study about Lego, which is a private limited company, and you're asked to analyse how the decisions its managers make might be different if it was a public limited company. So as always with these questions, we need to unpick the demands of the question to make sure that our answer is focused on the demands of the question. The starting point, what's the question all about? Well, clearly it's about management decisions in the context, though, of making them as managers in a public limited company. And very specifically, the wording asks us to focus on how those decisions would be different or might be different. That's what we have to focus on, how they would be different if the managers were operating in a public limited company. How many arguments do we need for our 9 marks? Well, we always look at the question, and the scope of the question is defined up here. Analyse how the decisions is plural, therefore we're going to need 2 arguments here, 2 differences to help us meet the demands of the question, not 1. Now, don't forget, with private and public limited companies, easy to mistake the two. There are some similarities. Both these forms of organisation are firms, are companies. They have limited liability to the shareholders. But there are some important differences. Shareholders in public limited companies, which I've just shortened here to PLCs for brevity, in many cases where the public limited company's shares are quoted on the stock market, most of the shareholders aren't actually involved in the day-to-day decision making of the company. Therefore, you need systems of corporate governance to protect them, arising from the so-called divorce between ownership and control. The people who control the business aren't necessarily all the owners. Other differences, well, public limited companies clearly will have an up-to-date share price. Their shares are being traded actively on the market. Therefore, the share price is moving up and down. And therefore, if the share price is moving up and down, so too is the market capitalization or the value of the company. Perhaps as a result of that, there's much greater scrutiny of the company's performance, not just their financial performance, but the actions of the business. And there is an argument, it's called short-termism. There is an argument that for public limited companies, managers tend to be more focused on the short-term performance of the business, maybe versus a long-term perspective, which is sometimes associated with privately held, often family-owned companies. So we picked out some differences there. How might we then develop those into points? Well, don't forget, we need a couple of points here. We need to have 2 ways in which those decisions will be different as a public limited company. I've put 3 on the screen there. I'm sure you could come up with some more. And I'm just going to pick 2 of them to develop to help us put together a couple of example arguments, example paragraphs. I'm going to pick the first one, the short-termism argument, that managers in public limited companies tend to be more focused on that share price, the market capitalization, the financial performance, rather than necessarily long-term investment. That might mean different decisions. And I'm also going to pick the second one, this idea that in public companies, often the shareholders are divorced, not involved in the running of the company. Therefore, that might influence the decisions that are taken. Okay, so let's have a look. Now, as always, I would encourage you to have a go at writing your own arguments, your own paragraph points. These are just meant to be illustrative of how to approach the question. We know we needed 2 arguments here to address the scope of the question, the decisions managers might make that are different. Well, here's the first one. Here, the argument is that management decisions may be different because they're more short-termist than if it was a private company. So let's just read through the argument, read through the point to see how we try to develop the argument, ideally including some of the case study so that our analysis is contextualized. As a PLC, Lego managers may feel their decisions will be scrutinised more closely by shareholders and the financial media, leading to greater pressure to deliver short-term financial performance, brackets, short-termism. So the decisions are going to be different because they're under more pressure. That's the argument. Let's develop that. Why is that different from a private company? Well, as a PLC, Lego may no longer be controlled by the Christensen family, the owners of Lego, but instead by external shareholders, such as pension funds, as well as potentially thousands, hundreds of thousands of individual shareholders. Most of these shareholders will want to see management decisions that lead to a higher Lego share price and therefore Lego's market capitalisation. For example, by increasing profit for the year or boosting revenue growth. Accordingly, management may become more short-termist in their decision making, preferring to make decisions that maximise short-term returns, such as profit, rather than longer-term rewards, e.g. investing in new product ranges, which might have been made as a private company. So that's a good argument. It's the short-termism argument, rooted in the context, nicely developed, big tick. But we know we need 2 points, so we need to allow 3 or 4 minutes to develop our second point. And this one is all about this divorce between ownership and control. Don't forget, this point is about the fact that as a PLC, most of the shareholders, if not all the shareholders, aren't actually involved in the day-to-day decision making. So let's run through it. In addition, managers running Lego as a PLC would have to take account of the divorce between ownership and control. And then just to explain it, which arises when a company is no longer managed day-to-day by the owners. So a comparison with a private company. For example, the board of Lego as a PLC would need to make sure their decisions were made in accordance with the corporate governance rules that apply to public companies. So there's a difference. These would include decisions about how much senior management are paid, what bonuses or incentives are offered, and how the performance of the company is reported through its financial statements. As a private company, Lego would have fewer restrictions on these kinds of decisions and how they are approved before being made. So in other words, it's a nice argument. As a public company, managers are more accountable, aren't they? They have more decisions to make that they need to justify. So there we go. Those are the 2 arguments. I think that would make a nice answer to that. Hopefully that will get you to level 3 between 7 and 9 marks. And it's using some nice contextualisation from the case study. Hopefully you find that useful. If there's any questions you've got about those answers, that approach, please leave them in the comments below. I'll put a link to the playlist of other example answers here. And as always, please subscribe to the channel, to the Tutor channel, and click on the bell icon to be alerted as soon as we add more videos like this to the channel.